Welcome to Money Map. If you've ever been confused by terms like index funds and mutual funds, you're not alone. These two investment tools are often thrown around in conversations about building wealth, but many people don't fully understand what they are or how they're different. In this video, we're going to break down both in the simplest way possible. By the end, you'll know exactly what each one is, how they work, and which one might be better for your money goals. Let's dive in. First, let's ask the big question. What are index funds and mutual funds? Imagine a big basket. That basket holds many different fruits: apples, bananas, oranges. In the investing world, that basket is a fund, and the fruits are individual stocks or bonds. Instead of buying just one apple or one orange, you buy a little of everything. That way your risk is spread out. Now, there are two major types of baskets: mutual funds and index funds. They both hold a mix of investments, but how they're managed is very different. Let's start with mutual funds. A mutual fund is actively managed by professional fund managers. These managers are constantly researching, buying, and selling investments in an effort to beat the market. Their goal is to deliver higher returns than the average performance of the stock market. Sounds great, right? Someone experienced is managing your money. But here's the catch. These managers charge fees for their service, and sometimes those fees can eat into your profits. We'll talk more about that in a minute. Now, what about index funds? Index funds are passively managed. That means no one is trying to beat the market. Instead, the fund simply follows an index. For example, if the index is the S&P 500, the fund invests in all 500 companies in that index. When the index goes up, your investment goes up. When it goes down, so does your money. There's no manager making daily decisions, which means index funds usually have much lower fees. So mutual funds active, index funds passive. But what does that really mean for your wallet? Let's compare them side by side. First up, fees. This is a big one. Mutual funds often charge higher fees, known as expense ratios, because you're paying for the active management. These can range from 0.5% to 2% or more per year. That might not sound like a lot, but over time it adds up. For example, if you invest $10,000 in a mutual fund with a 1% fee, you're paying $100 a year just in fees. Over 30 years, that's thousands of dollars gone. Index funds, on the other hand, usually have fees between 0.03% and 0.2%. That's just $3 to $20 a year for every $10,000 you invest. Next, performance. You might think that paying a higher fee for a mutual fund gets you better results. But here's the truth: most mutual funds don't beat the market. In fact, studies show that over 80% of actively managed funds underperform their benchmark index over the long term. Index funds don't try to beat the market, they just match it. But in doing so, they often outperform mutual funds because they're not dragging down returns with high fees or bad decisions. So if you're looking for simplicity and steady growth, index funds tend to be a safer bet. Let's talk about transparency. With an index fund, you always know what's inside. If it's tracking the S&P 500, you can look up every company it's invested in. Mutual funds don't always show their holdings daily. You might only get updates every quarter or once a month. That means you have less insight into where your money is going. Another important point is taxes. Mutual funds tend to trade more often, which can generate capital gains taxes even if you didn't sell any of your shares. That means you might owe taxes even when your investments stay put. Index funds trade very little. Less trading means fewer taxable events, so they're usually more tax efficient, especially for long-term investors. Let's recap the differences. Mutual funds are actively managed. Higher fees. Potential for higher returns, but often underperform. Less tax efficient. Less transparent. Index funds are passively managed. Lower fees. Match market returns. More tax efficient. More transparent. Now let's go over the pros and cons of each. Pros of mutual funds. Professional management can be tailored to specific strategies, may outperform in certain short-term situations. Cons of mutual funds. Higher fees often underperform the market. Less transparent, higher taxes. Pros of index funds: low fees, simple to understand, reliable long-term performance, transparent and tax efficient. Cons of index funds: won't outperform the market, may not offer niche strategies or specialization. So, which one should you choose? If you're just starting out, want low fees, and are in it for the long term, index funds are usually the better choice. They require less maintenance, are more predictable, and let your money grow with the market. But if you're looking for something specific, like a fund focused on a particular industry or strategy, or you believe in active management, you might consider a mutual fund. Just be aware of the fees and do your research. Want an example? Let's say you have $5,000 to invest. If you put it in a mutual fund with a 1% fee and it earns 7% annually before fees, your net return is 6%. After 20 years, you'd have around $16,000. Now take that same $5,000 and invest it in an index fund with a 0.1% fee. You're keeping 6.9% annual return. After 20 years, you'd have around $19,000. That's a $3,000 difference just from lower fees. Imagine the gap if you're investing for 30 or 40 years. Here's another advantage of index funds: they're easier to automate. Most investment platforms allow you to set up automatic monthly investments into index funds. That means you don't have to think about timing the market. You just keep investing consistently and let your money grow. This is called dollar cost averaging. It's one of the smartest, easiest ways to build wealth. So how do you get started? First, choose a brokerage platform. Some of the most popular ones include Vanguard, Fidelity, Schwab, Trade Republic, and Scalable Capital. Second, look for a low-cost index fund. Examples include Vanguard S&P 500 ETF VOO, iShares Core MSCI World ETF Schwab Total Stock Market Index Fund SWTSX. Third, start with what you can. Even 25s or 25s a month adds up. The earlier you start, the more time your money has to grow. And fourth, stick with it. Don't panic when the market dips. That's normal. Over time, the market goes up. Your job is to stay in the game. Let's finish with a mindset shift. Investing doesn't have to be complicated. You don't need to pick winning stocks. You don't need to time the market. You just need to start. Whether you choose index funds or mutual funds, the most important thing is to begin your journey toward financial independence. Let your money work for you instead of working for money forever. Thanks for watching. If this video helped you, give it a thumbs up, subscribe to Money Map, and share it with a friend who's just getting started with investing. Want a deeper dive into ETFs, index investing, and how to start with little money? Check out the next videos linked in the description. And don't forget to download our free beginner investing guide. The link is below. You've got this. Your future self will thank you. See you in the next video.